Better System Trader, episode 49.
Welcome to Better System Trader, the podcast to help systematic traders of all levels improve their trading. We'll give you loads of expert tips and practical advice on system design and validation, money management, trading psychology, and many other topics. Whether you're just starting out or a savvy systematic trader, we're here to help you improve your trading and find more success. This is Better System Trader with your host, Andrew Swanscott.
Hi, Andrew Swanscott here, and welcome to episode 49 of Better System Trader. I'm really excited to be sharing this episode with you because markets are constantly changing and trading edges come and go. And in an industry with such a low survival rate, where some areas are changing at an ever-increasing rate, what does it actually take to not only survive but thrive over an extended period of time? Well, the guest on this episode, Linda Raschke, has been trading for over 35 years. She traded for several hedge funds before starting her own, ranking 17th out of 4,500 hedge funds by Barclays Hedge for best 5-year performance. She's experienced a large number of changes in the industry. Some of them have been huge, but she's managed to adapt and continues trading even today. Linda stands out from the crowd for 3 factors: performance, longevity, and consistency. So what does it actually take? What has she learned over the years, and what can we do to improve our chances of performance, longevity, and consistency? Well, in our chat with Linda, we discuss some of the changes she's experienced over the years and the impacts this has had on trading. We also hear about her approach to modelling the markets, understanding market behaviour, trade management, day trading, and some fantastic questions submitted by fellow listeners, so make sure you don't miss those. But before we get to the chat with Linda, let's hear a quick word from our sponsor. How would you like to copy the trading of some of the best traders around, automatically taking the same trades they take in their own personal accounts? Traders like Michael Cook, Larry Williams, John Ehlers, or even Linda Raschke, the guest on this podcast episode. Well, you can with worldcupadvisor.com. For more information, check the show notes page at bettersystemtrader.com/49. Trading futures and Forex involves significant risk of loss and is not suitable for everyone. Now on to the chat with Linda. Hope you enjoy it. Hi Linda, welcome to the show.
Hey Andrew, thank you for having me.
It's really an honour to have you here today. I think we've been planning this session for maybe 8 or 9 months now, right? So it's really nice that we've finally gotten together for a chat.
I know, and I kept on putting you off by trying to push it to the next episode, which I'd love to do in honor of Nelson Freeberg, but we'll do this one first, and I hope people definitely take note when I get a chance to speak about Nelson's work.
Yeah, I'm looking forward to that one as well. Now, most people would probably already know your background, and there are plenty of other interviews out there that go through your career progression, so I don't really want to spend too much time on that aspect, but perhaps can you give us a very quick background for a little context here?
Yeah, because that will definitely add some character to your theme of system development and trading philosophies and so forth. And when I started, it was on the options floor doing market making in equity options. And this, of course, was right after 1980. It was a very new market and business, and nobody knew how to price them per se. So the arbitrage opportunities were huge. And being an options market maker was much different than being in a futures pit, for example, which is very directional and paper flow. And options were much more strategically oriented, a stronger math game. And everything about options is about relationships. You're arbing the relationship of the price in one series to the price in another, or the underlying stock. And of course, this is before we had such computerized models that could keep everything right in line, and there's really no edge anymore at all. So coming from that and being on the trading floor, it was a strategic orientation. It was a relationship-driven strategy. And at the time, too, we didn't have computers like we have now. So you're still having to watch the screen all the time and process many different, markets and series at once manually. So if I'm in a pit with 5 primary stocks and each stock is displaying a series of 12 calls and 12 puts, you can see all of a sudden you're juggling a lot right there. And we just had the old ticker tape at the bottom, and you could see the big blocks go by, and you definitely needed tape reading skills. It wasn't the same as being in a futures pit where you're getting the cues from the broker or the the crowd, the noise levels, although you did have some of that. So and also the person that originally backed me was a mathematician and relied heavily on logging indicators and bar charts at night. So I had some really good mentors, and I stayed on the trading floor in Philadelphia and San Francisco for about 7 years, and before I went upstairs to the screens. So that definitely is a different background probably than many of your other speakers, and influenced my style from there.
Okay, so we are actually going to explore those changes that you've seen in a little while. But first, let's jump to the trading that you do today. Can you give us some insight into the style of trading that you do?
I try to do a blend of 3 different programs and time frames. I say program, but I use that loosely because I try to break them out into separate profit centers, so they're not statistical, systematic programs per se that would be mechanical in orientation. But the first thing I do is the S&P day trading, and I love day trading the indices. And position trading them, but I started the S&Ps the very first day they were listed. That was a long time ago, and it was just the big S&P contract. And of course, you had to call down to the floor to place your trade or to a trade desk. And then the second thing I do is pretty much in one day, out the next day or 2 days. That was influenced a lot by a different type of modeling, where nowadays I always like to say it's get the main idea right. And for me, the main idea right is really capturing the trend for the day. So that's an important theme for people to think about, and perhaps not even the whole 24-hour day. It could just be the 4-hour session, and I'll describe a little bit later how I break that up. And then the third program that I do is for when I get those less frequent sort of daily, weekly chart formation setups where perhaps you could put on a position for a holding period of anywhere from 4 days to 4 weeks. And then lastly, I always have a special little, since every trader likes to, have a little gray area to play around with, I call them special situations. It could be a unique stock or there were 1 or 2 seasonal trades that I always used to do. So I kind of lump those into the fourth category because they're things that are awkward to try and model from a quantitative point of view, but perhaps my experience or my whatever it might be, is making a compelling case for me to put on a trade.
Yeah, okay, so a little bit further on that, I know that you use modelling a lot in your own trading, and I think it's probably used for the concept of getting, as you said, getting the main idea right. So can you explain a little bit more about the role of modelling in your trading?
Well, first of all, modeling is nothing more than asking questions. So I like to ask questions of the market and then see what I get back. So I've modeled everything under the sun, from time of day functions to what happens if you break out a 15-minute bar, and what happens if you do that at this time of day, and what happens, if you try using a derivative of price, which is not very successful. My initial modeling efforts were, aside from your basic market timing models, which is what I started off with, such as things like put-call ratios and, the McClellan oscillator, breadth, ratios, things like that. But then I got down to more nuts and bolts, price-oriented things, and that's where I started the basis for my my money management program, which I did in a formal way starting 1991, and then became a CTA, and then had my own fund. And that was a lot with the edge that a 2-period rate of change gave, which is so minute. You're not going to make a living with that in and of itself. But it helped me to capture this 2 to 3 day rhythm that is very prevalent, for a good portion of the time in these markets. And that was, of course, influenced by that Taylor Trading Technique book. And at the time, I had a research partnership with Steve Moore of Moore Research. And he lives out in Eugene, Oregon, and has done really fine work over the ages. And, at the time, we didn't have the resources available to us nowadays where, you could just, run things on TradeStation or something and grind away. But Steve could write everything in his own code, and he had a programmer do all this. And so we used to grind out thousands of runs on everything from volatility breakout systems to, what happened if you bought the first day the 2-period rate of change flipped up, to, everything. And then the way we would test it out, we always ran it across a portfolio of 20 different markets. And we would say, what happened if you exit on the close? What happened if you exit on the next day's open? What happened if you exited on the next day's close? And we would break out the long trades and the short trades separately. And then we would also block things into periods of 3 years at a time. So you could see if there was an upward bias in the market or a flat period in the market, and which markets were outperforming for that block and why. And it was a very robust way of doing this work. It wasn't with the intent to develop a mechanical system. It was an intent to see where is the edge. And so that's always influenced my modeling to this day, if you think of it more along the lines of actuarial tables, which is very much where Steve Moore comes from, because he's doing seasonal work, which is along the lines of actuarial tables. And, in terms of these windows, but it might not be timing sensitive in terms of your initial entry or your initial exit. And so that's definitely influenced all the modeling that I do. So from there, I was very blessed with a brilliant programmer who was part of my hedge fund team for many years, and brilliant just because he could make TradeStation cry the way he could program it. But we actually used quite a few different programs to do the modeling, and RENA systems and portfolio modeling and things like that. And that's all he did for eight years.
Wow.
I'd say, hey, Nigel, tell me what the first hour's range is in these S&Ps. And then you could see, we could look at 5 years later. Hey, what's the first hour's range in the S&Ps? For example, when we first started doing this type of stuff, it was 45% of the day's range occurred in the first hour. And now it's 60% of the day's range. So you can see all across the board in many of the type of models that we would develop this increased urgency on the part of the market participants. You see urgency off the opening in Asia. You see urgency off the opening in Europe. You see urgency off the opening in the U.S. sessions. And that in and of itself then lends itself to doing more modeling, taking these changes in behavior. So it's a process. It's always a process, and it's always just asking questions. And I put it in the category of a hobby. It's like the greatest hobby in the world, because in truth, I've never really been able to develop a mechanical system that I felt 100% confident to trade my own monies on. And there's numerous factors as to why, which I can go into later. But suffice to say, that's coming from a background of an individual. With the fund, we did run some mechanical systems over periods, but honestly, the value added to the bottom line was pretty minimal by the time you hired people to oversee these systems, and you had to deal with the friction in terms of moving size, very difficult. So I've never felt comfortable trading them, even though the actual models that I use are extremely durable and robust.
Okay, so if we take that one step further, so you've identified some models that determine a possible edge, but how does that actually apply to taking trades? Like, what's the progression from that model to you entering and exiting trades?
Well, first of all, you need to have a game plan for starters, okay? And as Taylor, I'll always go back to him because he's like my little Bible with some of his quotes, even though he was 100% discretionary. But you can see he had a process. He had a process for managing his data and organizing his data that was very important. And he always say, like, having a game plan is better than having no game plan, because if you do have a game plan, you'll know very quickly if it's the wrong game plan. So back to that thesis of trading is about relationships. If you're looking for a upward bias and you come in and you can evaluate it off of the 7 a.m. reading, you'll know very quickly whether you've got the right game plan or not. And so little nuances like that. So I'll come in with a bias of perhaps either we're poised for a breakout or a swing reversal or sort of a mean reversion type of reaction down, or perhaps we're just in one of those persistency of trend extended runs where you want to keep on entering in the first hour in the direction of the trend, because when you are in a strong trend, the first hour always offers the opportunity for the day. Okay, now I'm not going to get into the 24-hour session versus the U.S. pit session, but this is, a little bit of theoretical and practical for people to keep in mind. So, you come in with a bias and a game plan, and then it's very much, I hate to revert back to tape reading, but I'm really good at that. That's part of my from all the experience all those years over the floor. And I would bet that anybody that's been trading for at least 10 or 12 years minimum is pretty decent at tape reading, which is just watching the price, watching price relative to another price. It's nothing more than that. Seeing if there's an uptrend or a downtrend, or it's starting to hit resistance, or it's starting to, it stopped going down. Okay, so that's it's finding support. That's basic tape reading. But you can frame these things out if you want. You can say, okay, I'll use the breakout of a 5-minute bar or a 15-minute bar to initiate. In other words, you start to show you're coming back on the swing, and you can devise entries along those way. In fact, most of the day trading models in the S&Ps will either use a breakout function to enter, or if you're doing mean reversion, it usually waits till it comes back a little bit in the other direction, so you have a little bit of reversal, and then they'll enter, for those who like to do modeling, because I know that's pretty much your primary crowd. So back to what I was saying, you can set up structures, but the real key, I think, is that if you can note an increase in volume, which is a very easy thing to quantify, an increase in volume, range, and activity. Okay, that gives you your confirmation or your green light go that potentially there's a higher time frame player or stronger money flows at work, which is really the key for the game, because face it, 90% of the time your trades are 2 step forward, 1 step back, nickel and dime, and I don't care if you're trading a system, a trend following system, a short-term volatility breakout, or you're a discretionary trader. It doesn't matter. 10% of the trades are probably going to yield 60% of your profits. It's just like that. A small percentage of the days of the year are going to yield a larger percentage of the profits. 3 months might make your year, in bulk. So that's just the nature of the numbers. So the real key is when you get that volume and that confirmation that you've got the right game plan, that your model, you've got the right bias, it's really important to increase the leverage. It's really important to step it up or tee it up. And you might only do that on 10% of the trades, but that's a big part of money management that's neglected. Everybody likes to focus on the risk and the drawdown, which is important. But I think that with the use of discretion, you have a better handle on when to really use that leverage, where a model or a system isn't going to tell you that. Does that make sense?
Yeah, it does, yeah.
Okay.
So if I can just jump back to a statement you made about reviewing your models, I think you said, I don't know if it was just an example, 5 years. How often do you review or update those models?
When I start to question that something's changing, some I never review because they just still seem to work, And for the most part, the modeling that I do tends to use really no more than 2 variables and maybe 1 filter. So if you do the work along those lines, and the type of modeling I also do, I end up with a sample size of like hundreds and hundreds, and then I get to see, is this a thesis that can work across multiple asset classes and so forth, which builds your confidence even higher. So if I have a model that has a fairly robust outcome like that, it still holds up. The main changes in the market that I see, and this is something that with systems you need to be cognizant of, because a human can observe these changes much quicker than a system in general. Okay, so a system usually needs a little bit more data under its belt before it can make the change in context, which is really important. So the context that I'm talking about would be this alternation between the consolidation areas, which are much noisier than ever before. And the ranges are noisier and wider than ever before. So in theory, your stops would need to be wider than ever before. And like, for example, 3 ATRs versus the standard 2.5 ATRs, just as a generic way of looking at it. And I think this is one of the things that's nipped the trend followers in the butt, over the last number of years, is they are so reliant on that just 1 or 2 markets or outliers now to make up for all the stop outs. And that's why the individual, I don't think, is really well suited towards trend following. I don't think they understand that every trend follower has a 40% drawdown at some point. And how long does it take to make back up those losses? These are very important statistics for the people that do the modeling. What's your peak, drawdown to peak equity type of time frame? And so the human can identify the changes quicker than the model, and it's all about the context. So you go from these extreme states of very noisy consolidation to extremely efficient markups once that trend occurs, or the breakout. I'll just call it a breakout. You can trend on any time frame. You can trend on a 1-minute time frame, or you can trend on a daily time frame. But once the horse has left the barn, to use a old expression, you're not going to get the same retracements or back and fill or checks as you used to 10 years ago or 20 years ago or even 30 years ago. You don't get the small continuation patterns unless you go down to very small time frames. And so dealing with these radical state changes is very difficult if you lump all the data together when you're doing your modeling. But then how do you tell your system that you're in a certain type of environment? And that's, I think, the challenge with people that have an initial urge to just lump all the data together and grind 10 years and see if we can come up with some type of edge after optimizing everything. And it's just not going to hold up over time.
So are you saying there that the type of environment shouldn't be included in a model?
I think that you need to be very discriminating as to the model that you're developing and what you're trying to capture. So, for example, if I'm just simply modeling what % of the day's range occurs in the first hour, then it's not significant. And if I'm modeling some long-term market timing system along the lines that Nelson did, then absolutely you need to include bull markets, bear markets, flat markets, noisy markets, all these types of things. But that little middle ground is very difficult to determine how you're going to include a filter in your system, you see? Because, and it's very difficult to then pick and choose, I'm just going to model this 3-month period where we were consolidating after we just had a 5 standard deviation move on the weekly charts. So, but if I lump together that large period where you were trending, for example, the breakdown in the euro currency, I'm going to get perhaps answers to the question that might not be appropriate for the current environment. So I try to stick with, let me put it this way, my program 2, which is the 2 to 3 day time frame, is really a nice sweet spot because I found it's very difficult to look out too far, beyond the 2 to 3 days and have a sustainable edge. But here's another point to make, and this is, I'm getting a little bit ahead of myself on some of the type of work that I've done, and that is once you hit these pockets where there's persistency of trend, where you throw this little 2 to 3 day time frame of back and fill out the window, and instead we look at how many closes do we have above or below a 5-period SMA. And I've just given away all my lifetime secrets on little YouTube videos all over the internet that people can Google left and right, But the truth is, I really don't mind sharing this stuff. And, so we modeled out what happens once you have 7 closes on one side of the 5 SMA, simple moving average. Yep. And when we do our modeling, we will, again, break it down into 5-year segments, 10-year segments, and we model every market across the board that we can. And it was kind of interesting because the frequency of occurrence is one thing that we look at. So you would have periods where you hit at least 7 closes on one side of this 5-period simple moving average 9 to 12 times a year, which is actually significant. And then we would ask, well, what happens if you entered in the direction of that trend on the close of day 7? And this would be very counterintuitive for a discretionary trader because, for example, let's say that natural gas has just sold down hard and has closed 7 days in a row on one side of the 5 SMA. Your human instinct would be like, oh, this is oversold. I'm gonna look to buy it and see if it can retrace 2-3 days back towards the moving average. Your old proverbial regression to the mean type of thing. Yep. And in fact, if you entered on the close of day 7, and then we'll test out what happens if you exit day 8, day 9, day 10, day 12, no stops or anything, but again, this actuarial window. And of course, the answer is the longer the holding period, the larger the profits. Again, more counterintuitive, but in sense, you've got a huge markup or markdown, and you can't predict how far or how long that is going to go. And my experience is then it always goes further than you can perceive or think. And there's no way to measure or predict, So I've found every market on the board has gone anywhere from 24 to 28 closes on one side of a 5-period simple moving average.
Wow.
It's extreme. It's extreme. And so there's real gold mine here. And we can go back and we can look with discretion and say, okay, what were the conditions preceding these moves? Is that something that we can capture in our modeling? You see, so you can use this deductive logic and build. And I guarantee that if you have a spouse, they will never see you for 3 months. It's like going down the rabbit hole, So, but that's just a good example of this persistency of trend theme. And one of the things that came up with many of the questions that you sent me that people had asked had to deal with the struggle or the challenges that newer people in the business seem to be having. And I always see that there's this tendency to want to predict, number one. There's this tendency of saying, oh, gee, this market's gone too far too fast. It needs to come back a little bit. And so these exercises, if you will, tell us that we're not very smart, if we do that. And the reason I did this modeling is because it's human instinct. I mean, I'm like, this thing sold down 14 days in a row, It's got to have a little reaction back up, and then, once you get your head handed to you 2 or 3 times, it's like, I think I want to be on the other side of this for a change. How can I set up a structure that I can actually capture this instead of having to go through a few learning experiences? And that's where most of my modeling originated, is, gee, I don't know what's going on. I know what I'm doing isn't working. how can I find a way to be on the right side of this? And that's the thing too about trading, is that if you're a discretionary trader, or even if you're a systems trader, which I know very, very, very few people that make a living for their own account off of systems. But if you're interested in this business, you have to understand that things that feel comfortable usually don't work. And oftentimes the things that are the right things to do feel the least comfortable. And that's where this exercise of modeling things and quantifying things and reducing things down to just little numbers helps eliminate some of these behavioral biases. There's a whole school of behavioral finance, and these human biases that seem to get in everybody's way. And some people can never let go of those biases. But I guarantee if you get down to doing research, system, testing, modeling, especially doing stuff by hand, it's the best tool in the world for helping you get rid of some of these human biases.
All right, thanks, Linda. That was some great stuff there. Now, you mentioned, you've already mentioned some changes that you've seen in the markets over the past 3 decades. I think you mentioned an increase in noise and range, and also the impact that that's had on some types of strategies, for instance, trend following. But can you give us a little bit more insight into the changes that you've seen and the impacts it's had on other kind of trading approaches or models?
Well, I have to say every decade I've seen products come and go. So I think that traders need to always keep an open mind, that a great product could be there and it might not be there the next year. I mean, I remember at one time I traded value line options, in the pit. Well, that's gone. The value line futures are gone. The fancy futures are gone. A lot of these things are gone. I mean, look what happened to the SOS bandits. They're gone. I mean, so there's always new markets coming on board and, other products that just fall out for whatever reason. So I think trading in general, it's good to start off with one market. And I think the S&P, the E-minis will always be there. But, you always keep an open mind, too, because here's a great example. I remember it was in, I think, 2006, 2007, and the volatility in the S&Ps was getting crushed, and the average range was getting crushed. And I remember joking, and then it came to fruition, that the average daily dollar range in corn exceeded the average daily dollar range in the S&Ps. For a period of about a year there, depending on what your look back period was there for, evaluating the dollar average range. And that's a pretty strong statement, that corn, the most boring but deep market, it's starting to come to life right now, by the way, for all of those that you are sleeping on these grains. But that corn had a bigger, dollar range than the S&Ps. So that's, the actual volatility changes greatly. At one time, natural gas was a crazy, insane trader. And now we have changed to the fundamentals. It's probably never going to be that way again because we've got so much supply and new ways of processing it. So fundamentals can change, that can actually change the volatility of a market. It can make it greater or it can kill it. It can just become a dead market. The efficiency of the movement has definitely become greater. There's subtle nuances to execution. For example, nowadays, at least in the futures market, everybody uses icebergs or, hidden orders or, time slicing, these types of tools at our disposal. And same thing with on the stock side. I think 20 years ago, your average trade size was 1,500 shares, and then it dropped down to 1,000 shares, and now it's 100 shares. So that's pretty crazy to think about all the volume that's done, and your average trade size is 100 shares. That's really pretty crazy. Without saying, obviously, the impact of 24-hour global markets and the monies that have come out of the Asian sessions has impacted things.
Yeah. So what about strategies or models that have lasted the test of time? Have you noticed any commonalities between those type of strategies?
Well, here's something that will never go away, and there's a zillion ways to skin a cat. It's a good exercise. I don't trade them, but the simple volatility breakout systems will always have an edge. The problem is that the friction, because you're entering in the direction of the price movement, usually at periods where there's less liquidity, so you're not going to be able to move much size on them. And they're also a lot of work. They're probably a lot more work than people think. Even if you think that you're running it 100% mechanically off of your trade station, if you're doing it across the board, you need to pay attention when some of these, sugar opens, at night or things like that. It's not an easy game, but I think there will always be an edge with that type of short-term breakout phenomena. But with that said, like I said, I like to do the modeling because it's a good exercise to understand when not to take a mean reversion type approach, which seems to be a favorite strategy of short-term traders. It's a good exercise for people to do.
So on the flip side of that, what about stuff that is broken down?
A lot, my very best system that I ever had was called the Golf system. And it's something that I developed by hand in 1991, and it was on the S&Ps, and it initiated on the close. And I felt so comfortable with this that I was doing it myself, 100 lots on the big S&P contract, which sounds huge, but when you consider that the S&Ps were at, 500 or something back then, it's not as bold of a statement as it might sound. And it was exiting for a fixed amount. And that's a strategy that still works. But then what happened is you had the Asian crisis in, I believe it was 1997, in the Thai currency, and all of a sudden the gaps started becoming an issue, and it broke down that type of modeling or system. And I had called it golf because it was working so well. All my friends were doing it. I was faxing to everybody. We're all just like initiating our trades on the close. And the joke was like, hey, go out and play golf the next day. Everybody's dream, right? I'm just going to let this little printing press run in my basement while I sit on the beach and drink coconut drinks. It's so easy, right? All good things come to an end. So yeah, there's little fundamental changes in trading hours or things like that can impact systems.
So you've mentioned some of the changes you've experienced over the past 3 decades, but even today there are really huge changes occurring. For instance, in recent years we've had an explosion in processing power or computing capabilities, which have they've increased the accessibility and utilization of techniques like AI and machine learning. So what do you think about these techniques?
I don't think they make an impact at all. I was really fortunate to have a friend. His name was Ernie. I'm not going to give last names, but his son was one of the first to do artificial intelligence for NASA, and we got our hands on some neural nets, and we used to run this stuff in the early 90s with neural networks, which was very primitive compared to what they've got nowadays. But some of these things a neural network is not something that's going to be a system. It's what you would call a pattern classifier. Okay, so it could be a component in a system. It's just going to be a pattern classifier. In fact, that might be an appropriate type of tool for categorizing context that we were talking about earlier. But it's not going to be a system for yourself. And, people got to keep in mind, the AI and stuff like that. So what? So everybody's got it. So everybody's competing against everybody. It just creates more noise. And as far as I'm concerned, I love it. I love it because it gives liquidity. I mean, people have no idea how fabulous it is these days to have the liquidity that we have. It's brilliant. And, you've got billions of dollars on long-term macro strategies, and you've got the short-term speculators, and you've got the commercials, and everybody's in there on different time frames, sloshing different size monies around. So I don't think it's changed one thing.
Okay, excellent. And do you ever think about where trading could be heading in the future and kind of adjusting your approach to that?
No. Hey, nope. I just, there's a one common factor, and that is money makes the merry go round. So as long as there's liquidity, that's the number one thing that a trader needs to be concerned with. If there's ever an environment where liquidity starts getting taken out of the system, that's when it could become much more challenging. But we've had quite the opposite, to huge magnitudes. So I think there would have to be a serious reduction in liquidity before it really impacted some of the modeling that I've done. And then, it would probably happen. We'd have some big old ugly, depressing bear market, and then we'd just bottom out and flatline like the patient goes dead for a while, kind of like, we had something sort of similar in 1980 and something sort of similar in, 91, 92, patient was just dead for a while. Mm-hmm. And then they started pumping that liquidity and magically it came to life.
Okay, if we could just switch back to trading for a few moments, I'd like to ask you about intraday trading, because it's a very popular approach, especially I think there's a lot of appeal to it, but it can be very challenging. So you've been doing intraday trading for quite a while. Why do you think you've had so much success with that type of approach?
Well, a good part of it just comes with experience. There's so many subtle nuances to the tone and color of a market. And it takes a long time to build up to processing numerous relationships, which all aids in day trading. So, for example, if I'm day trading the S&Ps, I can assess in a pretty brief period of time whether I've got confirmation or non-confirmation with the Russell, with the NASDAQ, with the Dow. I can assess instantly, what the market internals are, if there's leadership in stocks, if I've got some momentum from stocks making new highs or stocks making new lows, if what the range was before, and where we gapped relative to the close and so forth and so forth. Because of experience, I'm able to put this together pretty quickly, and I think that really aids a lot with the intraday day trading. Now, you also need to have a vehicle that has a pretty good length of line, and length of line just simply means that if you straightened out all the intraday swings, it makes a pretty good long tape measure there, unlike something like corn, which just can basically go low to high or high to low and be pretty straight line. It's not going to offer intraday opportunities. So I think all these things are very important for day trading, because there's so many extra clues and wealth of information that the market can give us. But I think that people have to understand that putting that all together is something that takes a long, long time. It's like a radiologist has to go to medical school and then a special school, and then he has to spend 2 to 3 years, as an apprentice studying all these, x-rays or MRIs or whatever the heck they look at nowadays, CAT scans, before he has enough pictures in his head that he can say fairly quickly, this little gray area on the upper left of this scan is not right. You see, so that's what the newer trader is challenged with. Now, there's actually some wonderful tools that I think are helpful for people. I personally am not a market profile person in that it's not something that I rely on during the day, but I think it is excellent for newer people to look at and evaluate, because it allows you to put stuff into a context without getting caught up in this linear bar chart type of thinking. You see, it's very, very difficult to sit there and make a living trading solely off of like a 5-minute bar chart, even though I would recommend that somebody starting out start off with that and just practice making 2 or 3 trades, because you're going to get a high frequency of occurrence. Don't overtrade, just look for 2 or 3 spots. Notice the way that the market tends to have basically 3 main swings or legs a day. It might rally up, then it has a midday correction back, and then it finishes strong, something like that. That's an oversimplification. But I also thought that Jim Dalton's book, Mind Over Markets, did a wonderful job of describing I think it's around page 36 or 40 or something, the 6 types of days that you can have. And another reason why it's difficult to model systems if you just run all this generic data on a day trading thing. But for example, a trend day, a double distribution day, a normal day, a neutral day, as well as the types of action that you can see off the opening price, which is really important when you start to look at intraday or discretionary trading, because in the morning session, there's a lot more uncertainty. And so you tend to get a little bit more back and fill or testing in either direction, as opposed to the afternoon where the trend is more known and the temptation to make a counter trend trade in the afternoon is it's less forgiving if it's wrong, and there's usually not the same type of edge. So if you want to make a mean reversion type of play, you'll have more success looking at a time of day function, such as, the first 4 hours of the morning, something along those lines. Mm-hmm. And so these types of movement that we can get off the opening price, is it an open drive? Is it an open test reject? The book describes these. I'd get this book just for these 8 pages or 10 pages, Mind Over Markets. And the book describes this. So if you're a newer discretionary trader looking at stock index futures or even crude oil or something, I think that's worthwhile. And the main change nowadays versus, say, 20 years ago or however long that book was written is that, and this will just, I'll just take this one step further and mention some of the testing that we did around market opening. And that is, again, you can get this type of movement off of Asia Open, you can get this off of Europe Open, or you can get this off of US Open. And I actually use the 7 a.m. Central Time reading because 8 a.m. is when the bond traders used to sit down at all their institutional desks in New York, and pretty much still do. That's when they sit down and you get a little surge of activity or volume right around that time, even in the E-minis, believe it or not. So back to another thing that we did with our modeling, just for fun, and that was, I told you I had this brilliant guy who could model anything under the sun. So I was, first we started off modeling time of day functions with the S&Ps, basically the pit functions, and found that where were the sweet spots in the distribution of the times where the high for the day or the low for the day was made. So for example, if it was going to be an uptrending day, the low for the day came most frequently about 25 or 30 minutes after the opening. So you could test down a little bit first and then move up, right? And interestingly enough, on the short side, the high for the day would usually come in the first 5 or 10 minutes. So the message is that the urgency on the short side of the market is much greater. As a parallel in many of our models, that's why we always break up the long side and the short side. The short side has a lower holding time than the long side. These 2 to 3 day models, we can be long for 2 to 3 days and it tests out best. But the short side, you might want to close it out after a day and a half, and that's just that the markets go down a lot faster than they go up when they go down. So, but back to this time of day function. So I was like, this is such a piece of cake. I bet we could do this with every market. Wouldn't that just be a dream to find the little sweet spots in the data, right? So of course, we grind everything out, and it came up with Zippo, Zippo that was statistically significant. I'm like, nah, that's not right, because I'm seeing this. I know there's something here, And so we ended up modeling it out by breaking down the session openings, and of course that's where all the gold is, because the high for that session, or the low for that session pretty much comes around that first 30 minutes of the session opening. Like, duh. Okay. So, so that's how I ended up breaking down my day into 4 segments. I've got Asia Open, Europe Open, US Open, and then basically US afternoon, which can be dull in some markets, but actually not so dull in other markets. And I'm sure everybody is aware of the time of day function with Europe close. That's a given. More often than not, your trends are going to end, Europe close plus or minus 30 minutes. And then if it resumes or not is in part dependent on the volume for the day and some other factors. So it's just another fun example of modeling, but it's not going to give you a mechanical system, but it gives you very useful information by which you can incorporate either as a confidence level if you do have a system. Okay, it's going to give you that extra little bit of confidence that you're with that trend for the session. And then here's another thing that we modeled out. It's really rare that you get 4 consecutive sessions of trend. It's less frequent that it's not so frequent that you get 3 consecutive sessions of trend. So for example, what % of the time do I get Europe trend or Asia trend, Europe trend, U.S. morning trend? You see, what would be more likely is if you trended strongly in Asia and strongly in Europe, the U.S. morning will be rotation, consolidation, and then you might trend in our afternoon. Or you could get Asia rotation, perhaps people are waiting for Europe numbers or something, and then Europe can trend and U.S. morning can trend real strong. There are just little subtle nuances you see that build up in your head over time, and these are fun things to model. And you can actually, if you wanted to do little breakout systems, breakout off a 15-minute or a 30-minute bar off the first, opening range, that concept of moving outside the initial balance is not a new one. So like I said, you won't see your spouse for 3 months once you start going down this rabbit hole.
Yeah, you just gave people a lot of stuff to have a look at to investigate further. So thanks for sharing that. That was really interesting. Okay, so we're going to take a very quick break here. We're about to start the audience questions where Linda is going to share a lot more great info with us. So make sure you keep listening for that. We'll get right to it after this quick word from our sponsor. How would you like to copy the trades of a veteran hedge fund trader with 35 years of market experience? WorldCupAdvisor.com lets you do exactly that. With the launch of Linda Raschke's new Stock Index Futures and short-term diversified leader-follower auto trade programs, you can now make the same trades that Linda makes in her own accounts. That's right, Linda has her own money on the line, right along with her subscribers on every trade she makes in her accounts. World Cup Advisor identifies futures and forex trade leaders through rigorous screening, including live trade evaluation in the World Cup Trading Championship competition, and enables subscribers to mirror their trading buy for buy and sell for sell. As a subscriber, if your fill price is not equal to or better than your lead trader's fill price on any trade, that trade is commission-free from your authorized broker. There are more than a dozen futures and forex programs to choose from, and you can view complete actual performance data before subscribing. To learn more, check the show notes page at bettersystemtrader.com/49. Trading futures and forex involves significant risk of loss and is not suitable for everyone. Now back to the audience questions with Linda. Now I'd like to move on to audience questions. Now, we have had an absolutely huge number of questions submitted, literally pages of them. So we're not going to get time to go through all of them, but there were quite a few that were very similar. So I'm going to try and condense some of those into some more general kind of conversations. So the first one I'd like to chat about, which we have already discussed a little bit already, there were lots of questions on what's your favorite setup, your favorite entry technique, favorite indicator. So can you give us some insight into your favorite setups?
Well, first of all, the best setups have a fairly low frequency of occurrence. I'll say that flat out. So, it is important to be discriminating and selective when you are a discretionary trader if you're looking for a particular configuration. But those ones that I like to call them 90%ers, they just don't happen very often. But I love daily, weekly chart formations. For example, an ABC consolidation and an overall trend. That's when you're in a trending channel, that's something that'll work on any time frame. It just really doesn't happen as often as you might think. I love using the 120, 240 minute charts because they support this 2 to 3 days up, 1 to 2 days down. And we model all of this with ATR functions in terms of being able to quantify structure. So, the length of the swings, the duration of the swings, I mean, you can go to town on this stuff, but, I love the type of chart formations that you can see on, say, a 240-minute time frame for those of you that like bar charts. I love terminal wedges, like the daily, weekly chart formations. For example, I mean, a classic, beautiful one that occurred a couple months ago, EWZ, Canadian dollar, they all had this same, even crude oil, that bottom, after an extended weekly downtrend, and those 3 pushes and that terminal wedge, leads to an upside swing. So, but again, your frequency of occurrence is just not that often. And the other thing to think about with setups, everybody likes to talk, oh, what's a setup? What's a setup? Well, you have to keep in mind that when you go down and you allow not just the 90% trades to creep into your portfolio, if you will, what will happen is you need to then just treat it as a big numbers game and recognize you can have a setup and you can initiate, but the volume might not come in. The market's just going to give you whatever it's going to give you, and it might not be that much. So really, you want to go where the volume is and the market that's already in play. I think that's really important instead of, trying to trade in these dead markets or anticipate a breakout, I think is an exercise in frustration.
Okay. Another common group of questions that we got were on trading performance. For example, why do traders fail? How to cope with losses, the attitudes of successful traders. Another one, how to get out of a trading rut. So you've seen a lot of traders, I guess, come and go over the years. Has there been any commonalities between the traders that have succeeded and perhaps those that haven't?
I think so, absolutely. Although everybody has different personalities, but they, first of all, are a bit of loners. They're very independent. They don't sit there and look at Twitter and blogs and TV and all this nonsense during the day. I really think that if you want to be successful in this business, you have to make an extremely concerted effort these days to eliminate all these distractions. It's going to take you out of your game and it's going to make you question it. You need to do your own work. I see people, when they come into this business, they're not cynical enough. Honestly, you need to question everything that's being put out there, and you really need to be cynical about it. Even anything I say, if I give you something that I say, hey, this is a great pattern, don't believe me. Go test it for yourself, do your own modeling, do your own research, and make it your own. And do not believe anything that anybody says out there in print. You have to do your own work and learn it for yourself. I would also say that the people that I see with the best success either have some type of background like professional sports or poker or cards or music or some performance-oriented discipline, okay? Because you got to stay in the moment, and you got to take it one day at a time, and you've got to understand it's just a game. You have to put it in the context of numbers and a big stream of numbers. And if you are fairly emotional or reactive or impulsive or anything along those lines, this is just not the job for you, period. But on the other hand, the gold is, if you can find your little groove or create your own little playing board, okay, that's how a better way of putting it is, create your own playing board, then it is so scalable that's really the insane amount of money in this business, is that it's so scalable if you can come up with your own playing board. And that's what everybody should strive for, is ultimately, whether it's just going to be scaling, your own trading account, increasing size as it grows, the compounding, trust me, that compounding is incredible. Or, if you really want to take it to the next step in the big leagues, there is a hunger out there for new talent. But don't go knocking on doors until you have a real-time track record with your own money, and have done your own research and have your own game that you can offer something new and say, I am not going to be correlated with this group in your portfolio, and I'm not going to be correlated with this group in your portfolio because I just specialize in seasonality in the grains, or I just specialize in this short-term breakout on tick charts, or whatever it might be. But you need to find your own little niche. Is really important. And most of the successful traders that I see, I could be on Skype with 3 or 4 of them, and one person will be saying, I'm long right here. Doesn't mean anything to any of the others. It's just like, they're not going to care. No, I don't care what anybody else's position is, and you have to be that way. So if it's going to influence you, you can't let it into your day. Anything that influences you or pulls you out of your game, don't let it into your day.
Okay, so we have a question here from Casper. Casper's trading results have been stuck in a rut for a few months, and he would like to know, what should he be looking at?
Well, 2 things. You want to make sure that you're not over trading or making impulsive emotional reactions and so forth, stuff you've already heard. But let's just start with trade management. Because if everybody out there could eliminate their 1 or 2 biggest losers, I guarantee their bottom line would probably be 50% better, So start with trade management. And if you're in a rut or you just feel like you're a little burned out or too close to a market, it's okay to step back and do research. I mean, after my biggest losses, I always find it extremely therapeutic to do research because it actually makes me feel productive, although probably 95% of my research ends up going by the wayside. But let me just address this issue of trade management because it is probably the most neglected area of system development. And I don't think it's true that you can just flip a coin and with trade management end up with a profitable bottom line. Definitely your entries count. There's no doubt about that. Definitely. But the way that you manage a trade really can be addressed in a simple exercise. And I'll tell you what I do. We went and we analyzed the market structure. The swings. Is it a retracement in a trend? Is it a double bottom? Is it this? Is it that? All these types of things. And we categorized everything. Does it optimize out to play for a small target? Is it best to play for a large target, or is it best to trail a stop? All right, let's assume you weren't able to scale out. You just had single in and single out. So let's make this a little game, okay? I use a charting platform for my execution called Photon Trader. It's actually pretty cool because it has these candle volume charts, and you can see the volume, on the size of the bars. It's really swell. But I always said, wouldn't it be fun to put a little menu on the right-hand side for newer people, and they could all they have to do is initiate the trade. I mean, because people love to look for entries, right? Nobody knows where to get out of these things, but we just love to pull the trigger. So what we did is we modeled playing for these 3 options, and you can pretty much draw some very robust conclusions about the types of patterns, or if you want to call them setups or whatever, conditions, that justify trailing a stop, which actually doesn't happen nearly as often as you might think, versus the types of patterns that model out best playing for a small target, which is the highest frequency of occurrence, okay, versus playing for a large target. And I was used to joke, with this Photon platform that I trade off of, wouldn't it be cool, because you can trade off the charts, probably easier than any other platform out there. They could just put a little box on the right-hand side, and the trader could find the entry, because everybody likes to look for entries, and then check, okay, do you want to play for a small target? Do you want to play for a large target? Or do you want to trail a stop? And of course, it puts in an initial stop, and then it hikes it up, after a certain amount of time goes by, sort of like a parabolic type of function. And then you could go to the kitchen and make your peanut butter and jelly sandwich. You could take the dog out for a walk, whatever the case may be. But let the machine manage it, because that's where everybody messes up. Everybody likes to get into trades, and they always mess up trying to manage them, So if you're in a rut, okay, look at your own trading, and I guarantee a good part of it's either you're over trading or the trade management attentiveness is falling apart. And everybody's allowed one mulligan in this business for sure, but you can still bleed to death with a zillion little nicks. All right. It is true. A zillion little nicks, you'll bleed to death. And you don't want to end up in that way because it's very frustrating. So if you find yourself frustrated, you're not going to be in a good spot for discretionary trading for sure. Pour yourself into research. Why don't you look at your setups and say, would this model out best trailing a stop, or would it model out best, playing for a few ticks type of thing, and make it a little game and try and reduce the ego and the calling of where the market's going to go and having control over it in that way, and reframe it. You see, you're reframing it into, can I pick the best trade management option? And, if you wanted to, you could keep a little notebook of these things, then you can kind of see, I picked option A where option B was best, or gee, I'm trailing a stop too often and therefore I'm giving back too much on the retracement, or wow, lo and behold, I'm not putting any stops in at all. Gee, maybe that could be a problem. So, I do subscribe to using very wide stops initially because they should be worst case scenario. And for my own trading, I try not to let my stops get hit. If it just doesn't feel right or it's not working or whatever. My favorite button on my trading platform is the flatten key, because I just hit flatten. It's uncomfortable and it eliminates all resting orders and everything. In fact, I even had my programmer build in a flatten my portfolio, and you would be surprised how often I use that. Lots of times for a good reason though, for an exit on numbers when you have these big reactions, and I might have 5 or 6 different positions on, and I just want to capture it. I see the equity curve bounce up, and by the way, I do tend to trade a lot off of my equity curve as well, since somebody asked. But I found that my equity curve too much was going well up, in the morning session, and then I was giving back, so I'm like, okay, when I see that equity curve, get up to a certain point, it's like the Biggest Loser. I want to bank it, and so sometimes I found out that it's very difficult even for me to be managing without an algorithm or routine 5 positions at once, so if I just flatten out, it gets rid of everything, it locks it all in, and then I can regroup and I can look and say, I really liked that position, I want to put it back on, and I can do that, and I could usually do it fairly gracefully, and I might only want to put on one more thing. So that's what worked for me. But that trade management is really important for sure. And the equity management, by that, your equity curve, your bottom line is even more important, because I like to trade a lot of correlated markets, and you got to keep that in mind. If you're long gold and silver, that's a 90% correlation there for periods, or same thing when you've got this old risk on, risk off, which isn't so prevalent anymore. So it's not even managing an individual trade, it's managing the correlation in your portfolio.
Yep, thanks for sharing that insight into trade management, Linda. So a question from James, can you identify a couple of reasons why profitable trading is so difficult and takes years to achieve?
I think the ratio of valid patterns to noise is very low, probably much lower than people realize. And so this change between states that we talked about at the very beginning, this efficient trend versus this consolidation noise is more extreme than ever. And that's hard for people to grasp. And then beyond that, these human biases are so difficult for most people to overcome. So that's why there's this whole area of behavioral finance. So, and I'm not even going to get into, the fact that probably 90% of these people shouldn't be trading because they're not suited towards it with the right temperament and so forth. But you'll also have much greater success if you don't have to make money for a year. Let's say you have a spouse that has a very steady job, and you don't have to worry about paying the rent. That's a challenging position for people to be in, because most people cannot let go of the dollar amount. They feel like they have to make a certain amount, and that's a very difficult place to be in when you're trying to make it as a trader. It's, if it's like a professional golfer saying, you have to make this chip shot on this 17th hole or you're going to drop out of the rankings, I'd say many people can't deal with that.
All right, thanks, Linda. So we might jump up to some questions on trading technique. And we have a question here from Carl, which you kind of touched on a little bit at the start of the chat. But Carl would like to know, could you share with us why you have chosen discretionary trading based on indicators rather than automated trading?
Well, automated trading, you need a serious infrastructure and serious ability to run zillions of strategies 24/7 around the globe. So if you want to see the Kentucky Derby winner of auto trading, just simply Google Renaissance Medallion Fund. All right. Yeah. It's a different type of business model, just suffice to say. I have yet to see a person with auto trading make a successful living for a prolonged period of time. And by that, I mean, you got to be able to put 2 or 3 kids through college, mortgages, everything under the sun. You need a very consistent, steady revenue stream. And I've never seen that happen on a mechanical system with an individual. And I'm talking about not just 3 or 4 years, but being able to do it continually. When I had my hedge fund, we did make a foray into trying to build the infrastructure to take advantage of a lot of the modeling that I had done. And it was pretty serious, just so you know that I've invested a lot of money, over $3 million. We bought a technology firm and had about 80 servers. This is before the CME had moved out to Cermak. And, we hired a person that was writing our own gateways, which was a very serious venture. Then, we didn't have access to the type of data now where you can write to somebody else's API and use the third-party data on the back end. So this is what you had to do 10 years ago, write your own gateways if you wanted that type of infrastructure. And it's intensive because, every single exchange has to have different gateways. They all have to be managed and updated. And all of a sudden you've got like a team of 5 people employed just in this one area. And, and then everything becomes outdated. And it was crazy. I think after about $3.5 million, I stopped the bleeding and cut bait and said, this is not the road I want to go down. It's a very, very intensive business. And I have the greatest respect for these organizations, that have been able to do that. But it's not trading. It's a different type of business. So, all these people, when they start worrying about algos and this kind of stuff, I'm like, let them do their thing. More power to them. They provide, liquidity to the market, but it's a different game. It's a different business. And I'll just leave it at that.
Yep. Okay. Thanks, Linda. Now, I've got an interesting question here from Bengt. The first part of it, we've kind of already discussed already. Bengt is asking about strategies that you've maybe had to adjust or stop using over the last so many years. But the second part of his question is quite interesting. And Bengt says, in your opinion, are there any eternal truths that can be applied to shorter term trading?
Well, the truth is you can't predict, number one. I think too many people try to predict. And number two, it's a numbers game. It'll always be just a big numbers game, like poker. You can have a great hand, but that doesn't mean that you're going to win the pot. You have to keep playing the game and stay in the game. I think the biggest truth for me is something that I already repeated once, that the bulk of the profits occur on a very low percentage of the days, usually when there tend to be an increase in volume and range. So it really has nothing to do with setups per se. It's staying in the game and waiting for the market to give you that opening. And that's always going to be the case.
So we've got an algo trading question here from George. It says at the moment around 70% of trading activity is by algo trading by big banks. And around the corner we have AI such as Google's deep convolution nets. So George's question is, where should the private trader focus to make a profit when the likes of Google AI team up with Google Capital to enter the trading market?
Why speculate on things that have not occurred? I mean, I don't really think it's going to make a difference. You've got, like I mentioned before, you've got billions of dollars in doing macro strategies, offshore hedge funds, commercials. The main opportunities in trading come from supply-demand imbalances. These aren't things that Google AI creates. It doesn't create supply-demand imbalance. I just would assume that they're trying to take advantage of them just like you are. So you have to assume that this marketplace is exceptionally big. You have no idea how much money there is out there. So I really think there's room for everybody. And, maybe if you had 20 teams all using the same type of Google AI constructs, they're going to be competing against each other. Everybody's mining the same data. And if anything, you'll just increase the noise level a little bit. And so what? There's strategies that then capture the noise level. So I don't think it matters.
Yep. Okay, thanks. All right, and the next question is from Marcus, and it is there any single key understanding of the markets that you now know that you wish you had discovered a long time ago?
Yes, relative strength. Especially in the 80s. It took me about 15 years to figure out the power of relative strength, and it's huge.
Okay, now we've got a question here from Victor. How do you adapt trading in difficult market conditions?
What are considered to be difficult market conditions? For me, difficult market conditions are low volume chop, in which case I cut back my leverage and activity. Increase in volatility provides opportunity. So that's gold to me.
Okay, now we have a question here about volume. And the question from Rory, what part does volume play in your trading, and what volume indicators do you use or recommend, and where can I learn more about volume in trading?
That's a wonderful question, because we have, at our disposal volume statistics nowadays that we didn't have in the futures markets 20 years ago. So it's truly a luxury, and there's so many different ways of incorporating this into your models, or even looking at it visually. For example, I mentioned if you want a compelling visual, study these candle volume charts. That's what I have on my Photon Trader platform, because sometimes charts make a more striking impact than statistics. And these candle volume just simply is that the width of the bar equates to the volume. So it makes it very easy to see initiating volume at the beginning of swings, as well as the climatic volume at the end of swings. There's also, I noticed there's a huge increase in volume upon the penetration of little intraday swing highs and lows. And I suspect it's probably from little strategic algos in the marketplace, little breakouts that are just there to grab a few ticks. But in general, volume is what gives me my green light go. So anytime I get an increase in volume, it's a confirmation factor. Increase leverage, trade bigger size. There you go.
So have you found that volume is becoming less important because there's an increasing number of trades that are being executed or outside of the exchanges, or not being reported as part of that exchange feed?
No, I haven't found that at all. I mean, I can tell you that if I look at the first half-hour volume on the NYSE, which of course is just a very small percentage of the overall volume, but it serves as a proxy extremely well, and for what's happening on the day. I can compare today's 30-minute range to the previous 30-minute range to the previous Monday's 30-minute range, that kind of stuff. And if there's a significant increase in volume over the previous day, you'll see it in the bonds, you'll see it in the financials, you'll see it in the currencies, you'll see it in the metals, you'll see it in a lot of markets. And so until it stops working, I'll continue using that. But there's lots of ways to incorporate volume. It's especially if you're looking at breakouts from daily chart formations, you obviously want to see increase in volume and range, or some kind of breakaway gap or something like that. They're all confirmation factors. Like, yes, you're on the right track. Go for it.
Okay, now we have a question here from Gio. The biggest problem I and probably others have is that none, or if not few, of the techniques usually discussed are actionable. Neither are they statistically verifiable. So I would like to see Linda and your other guests discuss at least one repeatable technique that works over 70% of the time.
Ho, 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 ho. We want Santa Claus, don't we? Ho, ho, ho. Well, gee, play back my interview so far, and I'm sure you'll find plenty of little tidbits there. But first of all, let me say that a large percent win does not necessarily translate into the most profitable systems. Like, for example, that one that I mentioned, entering on the close of day 7 and exiting 7 days later when you get these persistency of trends phenomena, only works slightly better than 50% of the time. But if you traded that across a basket of, say, 14 markets, it's never had a losing year. So it kind of depends on which tree you're barking up. But let me just give you a few little tangible things then. Test channel breakout with a very small target. You can get a win rate of 70%. You can do breakouts of 15-minute bars at certain times of the day, or, breakouts of anything and get 2 to 4 ticks 85% of the time. Are you going to make a living off of that? Probably not. But, I can get your win-loss ratio up there pretty good. You can model a 2-period rate of change, making new highs or lows, say with a 30-bar look back, and you can get 0.5 ATR more in the direction of that about 70% of the time. Or you can model standard deviation functions and get win rates over 70%. For example, after you've just had a large standard deviation move, that would be the appropriate time to employ a standard deviation function. There's a million ways to skin a cat. The problem I see with beginners is that they want to employ something that is statistically verifiable, right? That they expect to occur within the first 10 to 20 trades that they make. So just make sure when you do your own testing or modeling that you have a large enough sample size, including all different types of market environments. And then you'll build up your own confidence factor, by doing that modeling testing yourself, which it sounds like you obviously do. Make sure that you examine the data to see the max consecutive losers in a row, because any system that gets a 70% win-loss ratio, I guarantee, is going to have 6 losers in a row at some point in time. So make sure you look at those little nuances in that. Here's a big tip. I prefer average true range, price-based functions, as opposed to anything that's derivative-based. But hopefully I gave you a few ideas. How about that?
Okay, now we have a question here from Ali. I think I've pronounced that correctly. I'm a beginner system trader, and I've heard on this great podcast, and I'm sure many other places, that some traders use walk-forward analysis, some use in and out of sample in the development, and others just use the whole data set. So what's your advice for beginners on what to do when faced with such dilemmas?
Well, first of all, let me address, you phrased your question from extremely successful traders that use walk-forward analysis. Okay. Just let me catch you there for one sec. How do you know they're extremely successful traders unless you've reviewed and audited long-term performance records from being a CTA or hedge fund? 2 or 3 years may or may not be meaningful. I just say this again to caution everybody out there who seems to take everything with a grain of salt, even what I say, especially beginners, back to this thing, who do not have enough cynicism. My answer is going to be, it depends on what type of modeling you're doing. Modeling is simply asking questions. So if I'm going to ask, for example, what % of the U.S. sessions range occurs in the first hour, I might look back 5 years and that's fine. There's no need for an out-of-sample testing on that type of question. But I will still update that 3 years later, If I'm developing a system or a timing model, then for sure I want to develop my system off the data in the middle and then see what happened out of sample at both the beginning and the ending blocks of data. So there's not one set and pat answer to that. It really depends on, are you trying to develop a mechanical system? All I would say, if so, make sure, regardless of whether you're doing out of sample or not, that you do include all types of market conditions, bull markets, bear markets, extreme volatility, and flat volatility, because what people tend to do is they tend to lump all the data together in their system development, which is not good. That's why I prefer to do 2 blocks, do 2 years, do another 2 years, do another 2 years, and then compare the results. Because data is very streaky. Something might work great for 3 months and then not work for 3 months. It's very streaky. So you have to see, where are the wins coming from? Where are the losers coming from? What happens if you chop off the 3 biggest wins or the 3 biggest losers? This really could be a whole textbook or a whole nother podcast on this topic. But that's my pat answer. It really depends on what you're trying to model, as if it's important to have an out of sample or not.
Okay, now a question from Mustengo. What evidence can you provide that you trade the exact same system methods that you sell?
I've never sold a system, and nor do I teach, and nor do I sell courses, and nor have I ever sold any courses. So I hope you know by now that, I try to do a lot of modeling and, discretionary trading. Sometimes you can capitalize on that, and sometimes you just have a bad day, or, you have the wrong game plan or whatever. But I still think that over time, it doesn't matter if it's a system or you're discretionary trading or whatever, you're still going to be there for a certain percentage of the great trades. And, you can trade every day, but you're still waiting for that opening where you're in sync and the market's in sync and you can use bigger leverage. And that's really the name of the game. It's not so easy that there's a black and white system. So I hope that gives a little insight.
Okay. And now a question from Ken on trend following. Do you find more benefits trading with the trend or against those trying to trade them using how you would expect a trend follower to trade?
I wish people would drop this trend following hang up. Trend following is very loosely employed to like the classic turtle type of approach, which is not viable for the individual, unless you're a very large firm with tons of capital to employ your strategy across a multitude of markets. You're just not going to survive while your portfolio is experiencing an 8-month drawdown, which it invariably will. So let me rephrase that for you. Trade in the direction of the supply-demand imbalance. And sometimes this occurs right at the start of a new swing in the opposite direction. Or it can come from a breakout, from a wedge, which might appear to be a total counter-trend trade, in the case of a terminal wedge. However, you're trading in the direction of the supply-demand imbalance. And then you'll see that trends occur on 1-minute charts, hourly charts, daily charts, etc., etc. But I think that's a better way of thinking about it, is trying to trade in the direction of the supply-demand imbalance as opposed to this trend-following cliche in quotes. I hope that helps.
Yep, okay. And now we have a final question here before we move on from Nikhil. Has the market really changed, or is it the same as it was 3 decades ago from the perspective of market risk?
Well, I have to say this, the average true range is much higher in almost every market. Thus, I trade with lower leverage than I did many years ago. I usually break things down by unit size. I'll do N number of contracts per 100,000, and that number of contracts is based on the daily dollar range of that market. So it's much lower now than it was many, many years ago. I can remember when the big S&P contract had a daily range of 3 points for a period of 3 months. And I can remember when $2 was a huge daily range for gold. So on the other hand, a huge plus these days, and I do consider the larger average true range a huge plus too, is that the liquidity is 10 times better now. And that is a very important thing when evaluating your risk. In particular, how easy is it to get out? So nowadays, in the E-minis, you can get out of 500 contracts, no slippage, 1 mouse click in a millisecond. That's a huge luxury. That's a big change from 3 decades ago. But yeah, you have to be mindful of the leverage that you're using, given the much larger average daily range. So I hope that is a good answer.
All right, thanks, Linda. Well, I think we've covered pretty much all of the audience questions, so thank you very much for that. Now, I'd just like to start wrapping up with a few quick closing questions on my own. So,
Aha, the surprise. I can see it. I'm getting blindsided. Okay, lay it on. All right.
Biggest lesson you've learned through trading?
Oh, like which one of 5,000? I'm writing the World Britannica of lessons I've learned from trading. The importance of really keeping an even keel and a steady balance. And I know it's true with me, and I know it's true with others, that you're going to perform best when you have the least amount of distractions in your life. And if you're in a period where you're going through a divorce or moving or having an IRS audit or poor health or any of these types of issues, even if you think you have a nice little mechanical system running in the background, it still needs attention, overseeing it. And if you can't give something your full 100% committed time, it's okay to step back. The markets are going to be there every single day. So for me, in the very beginning, it was very difficult for me to take a vacation. It was very difficult for me to say, no, there's a time to close everything out and go away and recharge your batteries, because it is a very compelling game, and it's a very seductive game. And if I take a week off, it takes me 2 or 3 days to kind of get back into the groove and the flow and like what I like to call my roadmaps, and but it was very hard for me to do that many years ago. And so, as true with most people, your subconscious is going to say, sorry, kiddo, I'm gonna like let some sloppiness creep in and bite you in the butt, where you're just gonna need to take some time off, and that's invariably what happens. So I learned that a couple times, way back in the heyday, that it is important to step back, regroup, get a fresh perspective, recharge your batteries. There's nothing wrong with that. And same thing for, you're not going to make money sitting in front of the screen 24 hours a day. You need to, after the markets close, you need to go out, do some gardening or walk the dog or go to the gym. I like to go ride a horse, play some tennis, do whatever it is, do whatever it is you need to do to completely get your head out of the game. I think that's really important, to not think about the market for a period each day. So other lessons I've learned just over time is that you just, I think that the more I've been in this game, the more I know that I don't know. I think Maria Muldaur wrote a song, something along those lines. And, there's just so much that continues to surprise me and amaze me after going on 36 years now. You just never can predict, how far a market's going to go up, how far it's going to go down, these types of issues. So that's hopefully words of wisdom that can help everybody.
Yeah, that's great. Thanks, Linda. Now, you've already mentioned one book earlier, the Jim Dalton book, but do you have any other favorite trading books you can recommend?
Well, I really like that Taylor trading technique, not because he gives any pearly words of wisdom on setups or conditions or trading, but, he's got some of the quotes there, are just so appropriate, even though he wrote these 30 years ago, coming in prepared to trade each morning and the importance of doing your own work and never make a trade unless it favors your play. And, I probably went through about 10 copies of that book, just highlighting the stuff that made sense to me, which was about 10% of it. In fact, I've got a mind to rewrite that book, in which case it'll probably be reduced down to about 6 pages, but you can see after all these years, I've got a list of 6 books that I would love to write, but they're probably never going to get written because the trading takes up all my time.
Yeah. Okay, and what's the best way for listeners to get in touch with you or learn more about you?
2 ways. I have a fabulous website that basically consists of 1 page that is intent was to be a blog, which I post to about once a month. So you can see my writing prowess is very deficient. There's a contact form on my website. You can ask any question there, and I'm happy to respond back. Just give me 2 or 3 days.
Excellent. Great. All right. Well, thanks so much for your time today, Linda. Is there anything else that you'd like to mention before we finish up?
Just stay tuned for my podcast in honor of Nelson Freeberg, a wonderful person. And I just have to say that everything I've shared today hopefully is in part, numerous things that people have shared with me along the ways in terms of not necessarily these particular details, but I wouldn't be where I am today if certain people hadn't helped me along the way and, shared things and the camaraderie. And that's the biggest appeal of this industry to me. Yes, I'm a loner when it comes to my everyday trading and so forth, but there's such a wealth of marvelous individuals in this business. And, I really appreciate your doing those podcasts. I know that you've been able to be a vehicle to share so much with other people, and I'm just grateful to be part of that process. So hopefully we'll talk again when I do Nelson's talk.
Yeah, thank you very much, Linda. Yeah, so we really appreciate you spending time with us today. You shared so much great stuff with us, which I'm sure is going to help lots of people. And I'm looking forward to our little chat about Nelson Freeberg and some of his research. So that one will be coming up very soon. But thanks again for spending time with us today. And it really was a pleasure. So all the best.
Thank you, Andrew.
Okay, so a big thanks to Linda for chatting with us today. It really was an honour speaking with her. I'd also just like to say a huge thanks to everyone that submitted questions for her. There were so many questions sent in, and even though we didn't actually ask a lot of them specifically, I'm really confident we addressed them all in our chat at some stage, so I hope you found Linda's responses as valuable as I did. Now, if you're interested in some more info on this episode, head over to the show notes page, bettersystemtrader.com/49. Now, as we mentioned at the end of our chat, we have a very special episode coming up soon on Nelson Freeberg. If you don't know of Nelson, he's done some really outstanding work, and we're going to go through some of that and see what lessons we can take for ourselves. So look out for that coming up soon, as well as a bunch of other great stuff lined up for the next few episodes. Anyway, I hope you enjoyed the chat with Linda today. I'll catch you at the next one. Thanks for listening to Better System Trader.
Thanks for listening to the Better System Trader podcast. The next step is to head over to bettersystemtrader.com for more expert tips, practical advice, and exclusive content. Catch us next time for even more great ways to improve your trading here on Better System Trader.